All right, let's just jump right in. Welcome to another explainer. Today, we are unpacking a seriously fascinating and frankly pretty wild chain reaction. We're talking about how a single geopolitical ceasefire completely flipped the script on inflation data and just unleashed absolute chaos across global markets. It is literally the perfect example of how hyper interconnected our modern financial system really is.
So let's hook right into the core data here. 3.5%. That is the US inflation figure for June 2026. Now, you might be wondering why that specific number matters so much. Well, it marks the very first decline in inflation we've seen in 5 long months. 5 months, that is a massive deal for the markets. And honestly, it got a ton of people totally off guard. Which brings us to Section 1, the inflation turning point. So how exactly did we get here? I mean, how did this 3.5% figure actually beat the consensus forecast of 3.8? If we look at the data directly from the Bureau of Labor Statistics, it actually breaks it down perfectly. You've got food and core items staying relatively flat, right? But then look at energy. Energy is down 5.7% month over month. And gasoline, get this, a staggering 9.7% drop in a single month. That right there, that is the anchor that pulled the entire headline inflation number down. But why on earth did gas drop that much, that fast? Well, the root catalyst here is entirely geopolitical. Basically, a temporary ceasefire between the US and Iran immediately eased the pressure on global oil markets. I mean, just the news of this agreement alone created this massive deflationary ripple effect across the whole energy sector. And as we just saw, that directly cooled down the US Consumer Price Index. Moving right along to Section 2, crypto market liquidations.
Okay, so you know how this goes. When inflation drops, markets immediately assume the Federal Reserve is going to ease up on interest rates. And high-risk digital asset traders, they reacted instantly to the prospect of cheaper money. The result was this absolutely staggering figure, $376 million. In just 24 hours following the CPI release, the sheer violence of the market reaction was on full display. Over 85,000 traders were liquidated. We're talking $376 million completely wiped out as the market just rapidly shifted direction.
Let's actually break that wipeout down a bit. Ethereum led the massive wave of short liquidations at $127 million, closely followed by Bitcoin at $113 million and Solana at $13 million. What's super fascinating here is that the vast majority of these wipeouts, they were short sellers. Traders basically betting the price would go down, who were suddenly caught totally, completely off guard as prices rallied on the good inflation news. It just goes to show, digital assets reacted violently to this changing macroeconomic tide. I mean, Bitcoin actually climbed right back up above $64,000 on all this renewed optimism. But this massive leverage wipeout, it perfectly demonstrates the extreme whiplash volatility of crypto assets. A single positive inflation report halfway across the world can literally cost short sellers hundreds of millions of dollars in a matter of hours. Just wild. All right, let's pivot to Section 3, the case for gold. So in stark contrast to those chaotic swings we just saw in the crypto market, gold is an asset class historically famous for doing the exact opposite. It acts as this premier inflation hedge and holds a very, very low correlation with stocks. For decades now, it has maintained a core reputation as a long-term portfolio stabilizer. Basically, when crises hit or when inflation threatens the purchasing power of your standard fiat currencies, gold is that traditional safe haven that investors naturally run to. I mean, just look at gold's proven historical track record over the last 50 years or so. Back in 1971, the modern fiat currency system begins. Then the 1973 oil crisis happens and gold spikes 65%. Fast forward a bit to the 2020 COVID-19 pandemic, and gold pushes right past $2,000 an ounce. And now here we are in 2026, and geopolitical volatility is once again driving major movements. It responds to these macroeconomic and geopolitical shocks almost entirely predictably. But, and actually, this is a really big but, gold is not completely immune to market cycles. Take a look at the early 2026 paradox we just lived through. Gold hit this staggering all-time high of $5,589 an ounce in January, driven by war fears. But then it crashed nearly 25% by March. Why did that happen? Well, oil shock sparked massive inflation fears, which led the market to expect higher interest rates. And higher interest rates make non-yielding assets, like gold, way less attractive in the short term. However, zooming out paints the real long-term picture here.
Despite those wild short-term depths we were just talking about, gold has historically averaged a very solid 8% annual return over the last 50 years. And crucially, it maintains that low correlation with equities we talked about. Like the old saying goes, when stocks zig, gold often zags. And honestly, that is exactly what you want for long-term portfolio protection.
And this long-term performance directly impacts your money. Check this out. Based on a 20-year study, allocating even just a 5 to 10% slice of a portfolio to gold consistently outperformed a traditional zero gold strategy. To put that into perspective, a 10% allocation took a $100,000 portfolio all the way up to $250,000. This is largely because gold essentially minimizes the depth of your losses, the drawdowns, when the stock market is having a particularly bad year.
Which leads us to our final part, Section 4, Ways to Invest. So you might be wondering, how can you actually position gold in a modern portfolio today to take advantage of all these dynamics? Well, there are two main avenues we look at: physical gold versus virtual gold. Now, physical gold means the real deal, actual bullion, coins, or jewelry. Virtual gold, on the other hand, refers to financial instruments like ETFs, mutual funds, mining stocks, or futures contracts. The trade-off here is pretty straightforward. Physical gold means you absolutely have to think about insurance and storage. Virtual gold, however, offers much higher liquidity, meaning you can buy and sell it with just a simple click. Diving just a little bit deeper into the physical side of things, holding physical gold bullion provides direct, tangible ownership. You hold it, you own it. There is literally zero counterparty risk. But the minimum capital requirement is usually quite high, and you've got to factor in the logistical costs. Secure vaults, professional custodians, insurance, all of that can definitely eat into your overall returns. Now, for affluent investors, there is actually another layer here: private market options. We're talking about things like private gold funds, vaulted gold, hedge funds, and alternative investment funds. These vehicles essentially pool large amounts of capital, or they use really complex derivative strategies to try and generate outsized returns. Naturally, they have a much higher barrier to entry, but they do offer bespoke, highly targeted strategies for high net worth portfolios. So all of this brings us to a final, really crucial question I want to leave you with today. Does your portfolio have the right balance of risk and stability for the next geopolitical ripple? I mean, as we've seen today, a single ceasefire agreement overseas can cool US inflation, instantly liquidate hundreds of millions of dollars in the crypto market, and once again reinforce the 50-year track record of gold. The ripple effect is very, very real. Thanks so much for joining me on this explainer. I really hope this helps you look at your own strategy through a much clearer macroeconomic lens. See you next time.